Live from the Jamaica Pegasus in New Kingston for this, the release of the third quarter Business and Consumer Confidence Indices results. On behalf of the Jamaica Chamber of Commerce, my name is Andre Gooden. I'm the chairman of the Jamaica Conference Board and delighted once again to be your host and moderator. Special thanks and recognition to our sponsor, GK Capital Management Limited, and special welcome to our presenter from GK Capital, Mr. Kareem Tomlinson, Managing Director. Also to our main presenter this morning, Mr. Don Anderson, Executive Chairman, Market Research Services Limited. Also to our panelists, Mr. Gerald White, Vice President, Investment Banking, GK Capital, Mr. P.B. Scott, Chairman, CEO, Mossen Group, and Mr. Sidney Thwaites, President of the Jamaica Manufacturers and Exporters Association. So the last quarter, second quarter, we saw a dip in business confidence, a slight dip in business confidence, and likewise optimism on behalf of consumers saw a 2.9% dip. We anxiously await what Mr. Anderson's results will show for this quarter. Special welcome again to the several persons joining us online. Questions and comments will be facilitated through the chat room, and at the end of the presentation, the same will be available through the quick Q&A section on your on the platform. You can either direct your question to a specific panelist or a general question, and I can sort of guide the question at that time. We'll try to leave as much time as possible at the end for questions, because we know that the information is rich. It's a lot to unpack, so we expect and encourage feedback. So before we start, I just wanted to acknowledge again Don Anderson, Executive Chairman of Market Research Services, and congratulating him on his recent Honorary Doctor of Laws, which was presented to him by the University of the West Indies. Thank you. Congratulations, and well-deserved. Right. So as we anticipate your presentation, we ask Managing Director, GK Investments, Mr. Kareem Tomlinson, to move the sponsor's remarks. Please welcome him.
Morning, everyone. Mr. Philip Ranson, President, Jamaica Chamber of Commerce. Mr. Paul B. Scott, Chairman and CEO, Mossen Group. Mr. Sidney Thwaites, President, the Jamaica Manufacturers and Exporters Association. Mr. Don Anderson, Executive Chairman, Market Research Limited. Mr. Andre Gooden, Chairman, the JCC Conference Board. Other members of the Jamaica Chamber of Commerce Executive, members of the media, guests online, ladies and gentlemen, good morning again. The focus on economic drivers is always a must. As Jamaica continues on the path to becoming the true place to raise families, do business and more, the drivers in this context are manufacturing and MSMEs. As a significant driver of economic growth, this sector not only creates jobs and other numerous investment opportunities, it accounts for 9% of the country's total GDP. Annually, as a nation that speaks of getting there to big goals and dreams with more investments in the sector, as well as in the people behind the industry, the bus is moving. And at GK Capital, we are here to play our part in supporting these goals. As the 6th largest industry overall and key player in the goods producing sector, manufacturing has demonstrated robust and aggressive performance constantly, with exports increasing from 30% to 70.3% of total exports in 2022. But who is supporting them during this? It's always lamented that policies, funding, and more prohibit manufacturers from becoming their best selves. While there are several factors at play here, GK Capital stands here in support of the sector and what it means for Jamaicans. At GK Capital Management, our mandate remains simple: to provide our clients with funding to support their best versions of themselves. We're your support, working with you to get the best for your brands now, to empower businesses to reach their full potential. We believe that every manufacturer, regardless of size or industry, deserves the opportunity to both scale and thrive. And that's why we're dedicated to helping you navigate the challenges and seize the opportunities that come with growth. As the sector has so many changes with artificial intelligence, pricing challenges, logistics, and more, funding should not be an issue when it comes to performance. Whether it's funding for research and development, expansion into new markets, or investments in cutting-edge technology, we're here to support all your goals. Our team of experienced professionals understands the unique financial needs of manufacturers. We offer a wide range of tailored solutions for your business. More than just title sponsors for this event, our team is ready to connect with you as you take the next steps in your growth, from funding to preparing to list on the market to consultancy. Whatever the need is, we're here with you every step of the way. Thank you very much, ladies and gentlemen.
Thank you very much, Karim. And we are thankful for the support and sponsorship of the GK Capital Management team. Without further ado, we will invite Mr. Don Anderson, Executive Chairman, Market Research Services, to join us and make the presentation of the third quarter Business and Consumer Confidence Indices. Please welcome him.
Good morning, all. Good morning to the distinguished panelists here. Andre, thank you very much for your introduction. It's a pleasure for me to be representing my company, Market Research Services Limited, again, in making this presentation on the third quarter of 2024, Business and Consumer Confidence. I need to, as usual, give you a bit of background to the study. This was initiated by the Chamber through the Conference Board all the way back in 2001. And we're very proud to say that our company has been involved in all the fieldwork and now all the presentation as well of the indices as they arrive. So we're now in our 23rd year working on this particular project, and therefore if you multiply that by 4, with over 90 consecutive quarters of data that we have accumulated over all these years. So we're here now presenting the third quarter of 2024, and Andre initially sort of indicated or mentioned that there's been a slight fall off in the third quarter of 24, and what we find is that as we go through, we will see a pretty flat line going through both the consumer and the business. But we will start, and I hope this thing works right the way we should. It does. Right, so here's what we are looking at for the third quarter of 2024, and we have a pretty long time series all the way back from 2001, as we indicated. We can see the sort of dips and the rise, so to speak, in the indices going over the last 23 years. The last quarter we're talking first of all about the consumer confidence. The first quarter of 2024, we were, just about at 168 index of 168. We fell off somewhat, and where we are right now is that over the last 2 quarters, consumer confidence has fallen by just under 2 percentage points, 0.7 between the second quarter of 2024 and now, and an almost the same fall off in the first quarter against the second quarter in 2024. So there's hardly any change really, And that's a pattern, but we can take a look at the progression over the years. And if you see 3 peaks there, I like to mention that those were years surrounding election times when expectations rose by virtue of the kind of language and so on, and the promises that were made pre-election, and confidence fell off substantially 6 months afterwards. So those peaks are what are being reflected there, and the kind of promises made and promises not kept that resulted in those peaks. But that's a historical pattern. Where we are right now, there had been a fair amount of consolidation over the last couple of years, and of course dented by the COVID situation, which obviously impacted all of us significantly. So let us look at current business conditions. Now, this is how consumers perceive current business conditions. They're not experts, but they feel it, and they're reflecting to us. And I should mention the parameters of the study. We're interviewing in excess of 600 persons. Every day, virtually, we're in homes interviewing persons. 600 persons as far as the consumers are concerned. We always oversample by 10%, so our eventual sample is generally between 600 and 660. Anywhere between that's acceptable and gives us the appropriate margin of error with which to work. So, if we look at how consumers look at current business, what are they saying? And we've looked at the second quarter of 24, the third quarter of 24, we've looked at it, the corresponding year-to-date situation, so third quarter of 2023. And if we look at the top bar, in the second quarter of 2024, 15.7% felt that business conditions were good. Where are we in the third quarter of 2024? 15.4%. Hardly any change. All right? When you look at it from the perspective of this third quarter of 2023, it's a pretty flat line at 15.4%. So there's been no change really in how the consumers feel about current business conditions. And we'll tend to look at that strong positive, that good. When we look at the average, so that's a big bunch. And we have, again, very little change. 72%, 74%, and 69%. So really not much change. But you could say that this year, there's a higher degree of average rating of current business conditions. And when you look at the negatives, which is those who consider current business conditions to be bad, it's hardly any change again between 12%, 12 and 12.2% in the second quarter of 2024 and the third quarter of 2024 at 11.1%. So consumers aren't excited about what's happening in terms of business conditions, current business conditions. What about jobs? Let's get this right. Okay, here we are. Consumers have never, in the 21, 23 years that we've been conducting this study, have never been particularly optimistic about jobs. That's a standard. When we look at it, the numbers of consumers who feel that jobs are plentiful has been generally less than 10%. It's a pretty serious commentary on how they feel about their own situation. So where are we? In the second quarter of 2024, we had 7.7%, 8% roughly, who said that jobs were plentiful. Third quarter of 2024, that's 9%, but less than 1 in every 10 consumers feel that jobs are plentiful. Are jobs adequate? Well, a pretty large chunk feel that jobs are adequate, but we note, expressed by that red bar, that a very high percentage of consumers feel that jobs are in short supply, and therefore it doesn't augur well for how they see themselves moving up in the social scale or social ladder in the short run. So very few consumers believe that jobs are plentiful, and this has been the pattern over the 23 years that we have done this particular study. What about expected business? This is a perception of the consumers bear in mind, but the very important thoughts coming back from that 634 persons that we interviewed over the last 3 months. And I should indicate that we go quarter to quarter, so our fieldwork started for this particular quarter in June, middle of June, and we went all the way through to the middle of September. So we covered a good 12-week period, and this is the reflection of the consumers' views. So 30% in the second quarter expected business conditions to be better. What is it in the third quarter of 2024? No change really, 29%. So again, we have a pretty flat line here. But if you want to take some encouragement from the look at the third quarter of 2023, that was 25% who felt that business conditions could be better or would be better in the short run. That has moved up to 29% second quarter and third quarter of 2024. We want to move to expected jobs now. Remember, consumers feel that jobs are scarce, but here is optimism that they are expressing, because against the fact that 9% believe that jobs are plentiful, average 9%, under 10%, we now have a situation where 28% in the second quarter of 2024 believe that the situation is going to get better. So they're pretty optimistic. 27% it is in the third quarter of 2024, which is a slight, 1%, one index down, and 26% in the third quarter of 2023. So again, we're looking at a pretty flat line over the last year, all right? So consumers aren't optimistic about jobs going forward, despite the fact that we talk about low levels of unemployment, but the consumers themselves don't feel that there is a lot going for them, either now or in the immediate future. So, against that background, you may feel that this is counterintuitive, because they do expect their incomes to increase. So you may wonder how. And we remember we are gathering official data, so we are not accounting for any other source of income that consumers might have. But generally, consumers aren't optimistic about their job situation, but here it is that a significant number of them expect that their household income will improve. Kind of counterintuitive and so on. But this is their own thinking, and one wonders whether it is hope rather than real expectation. But 52% of all persons we interviewed in the last quarter, June to now, expect their household income to increase, as against 47% in the previous quarter, second quarter of 2024. And that's a noticeable increase from that 49% in the third quarter of 2023. So what does this mean for their intention to purchase? And we've been plotting over these years whether they're going to buy a home or a vehicle or take vacations as the need arises. What we see is that there is a generally higher propensity to take vacations, which are, I guess, less financial outlay, than there is to buy a home. So that we look at the situation, 43% in the second quarter of 2023 said that they would be prepared to buy a home because, they need a home and they would like to buy a home or a second home. 45% in the third quarter of 2024, so that's a slight improvement, and that's significantly up from the 38% in the third quarter of 2023. So vacation plans are in fact pretty solid. And again, this is probably the lower hanging fruit, because when you go higher up, the purchase of a vehicle is obviously something more costly, and similarly, purchasing a home. So that the indications are that persons are inclined to take vacations more so than they are, and it's the availability of disposable income to a large extent, which is actually featuring and driving this particular data. I'm moving a little quickly through because we do have a fair number of charts to go through. So we asked consumers how they felt about the economy going forward. We have here a situation in the second quarter of 2024 where 26% said, well, we believe business conditions are going to get better, compared to the third quarter of 2024 where 24%. So there's a slight fall off in the expectation that business conditions will get better. Again, this is consistent with the kind of conservative estimate, the conservative kind of projection, and the conservative belief amongst consumers that situation is going to improve for them. So, having established that 1 in every 4 of the consumers we interviewed believe that business conditions will get better, we asked them, well, what are the reasons why you say that? Interestingly, this is not necessarily in order of numerical importance or value, but these are the top 5 reasons that they gave. They're just being optimistic. So they're not basing this optimism on anything that's rather solid that they can point to. But then again, the consumers are speaking from their heart. So they say we're pretty optimistic about the things changing. And then they believe that there has been growth in some sectors, perhaps particularly in tourism. Entrepreneurship is on the rise. They're also saying that the economy is showing signs of improvement, coming, of course, out of COVID. And finally, that new investors and new investment is coming in. So these are the top 5 reasons why that 25% of the persons we interviewed at the consumer level say that business conditions are going to get better. But note that more persons, 29% in the second quarter and 35% in the third quarter of 2024, believe that business conditions are going to get worse. So we did the same thing. We said, well, what are your reasons for saying so? What is driving this kind of pessimism? High cost of living. And we will see in a later chart that consumers are very, 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 very distressed with the rise in prices that they are encountering on a day-to-day basis. But we'll see that in a later chart. So, high cost of living. And these are spontaneous responses. We never prompted anybody. We said, tell us why you think that the situation is going to get worse. And these are the spontaneous responses that we have trapped. Government not assisting enough. And people still looking to government to help them out of their plight. Lack of employment. Strange, because the unemployment rate is down to its all-time low. But consumers are saying, we're not getting the jobs on a consistent basis to be able to sustain ourselves and meet our daily household needs. Increase in crime, a factor which we'll see come up again later on as a serious deterrent not only for the consumers but for the businesses. And the top 5 reasons completed by lack of disposable income. So the consumers are pretty much distressed in terms of how they see the situation, and more of them believe that the economy is going to get worse before it gets better. So we talk about prices. This is something that we've been tracking for the last maybe about 5 years, yes. Right? Because we wanted to know, well, how are you responding to prices? And 72% of the consumers that we interviewed say that prices have increased significantly, and 23% moderately. So 9 out of every 10 consumers say we're faced with increased prices of commodities that we buy on a day-to-day basis to sustain ourselves. Very few people speak any other language than a significant increase in the prices of goods that we have to buy on a regular basis. So, again, pretty open-ended. Nobody was prompted. We said, what is the most critical issue that you believe needs to be addressed urgently? Absolutely unprompted. 62% of all consumers we interviewed said crime and violence. Of course, the stats that we hear talked about suggest that there has been a fall in crime and so on. The perception amongst consumers is that this is not so. 62% of them said this is the most critical issue that we have to face and address urgently, followed by unemployment. 9% poverty 6%, and we have a whole slew of other answers going down. But predominantly, it is 62% who cite crime and violence as the most critical issue that needs to be addressed right away. Probably even more worrying is the corollary chart that we have here. So over the next 12 months, how do you feel the situation will evolve? 69% of all persons that we interviewed, bearing in mind that 62% say that crime and violence is the most significant and the biggest issue to deal with right now, 69% of the consumers we interviewed said they expect it to get worse. Quite worrying. 9% said it's going to get better, and this spans just about consumers of all kinds of socioeconomic demographics and so on, from upper income, low income, middle income, young persons, older persons. When you have a number as high as that, it means it spans across the spectrum of the demographics. So, in your view, again, these are consumers talking, they aren't experts, but we said, what should be done to address crime and violence? Totally open-ended, spontaneous. More jobs for young people. So they see a correlation between the absence of or inadequacy of jobs for young people and the level of crime and violence. Programs for the unemployed, 32%. Clamp down on corruption, 31%. More stringent penalties for fines and fines for crimes. Better paying jobs for the youth. So we can see what the consumer is thinking through, what's in the minds of the consumers. And these are pretty high numbers, all right? 36% more jobs for young people. Programs for the unemployed. Clamp down on corruption. More stringent penalties and fines for crimes, and so on. So the consumers are putting forward and postulating their own thoughts as to how crime and violence could be dealt with, being the biggest issue that we face as consumers from the perspective of the consumer, right? So we, again, maybe about 3 years ago, and you correct me if I'm wrong, I think it's about 3 years ago, we started to look at this particular piece of information. We identified about 9 different sectors: the police, the small business sector, the government, health services, roadways, public transport, etc. We said, what's the degree of confidence you have in each of these sectors? And tell us the extent to which you think that this will improve, your confidence level will improve. Well, look at that number. In the third quarter, 18% cited the police, and it's almost the lowest except for the roadways. People don't have a lot of confidence that the roads are going to be fixed in a short space of time, all right? 16%, and the highest degree of confidence, if you wish, or the lowest degree of non-confidence, put another way, is in small business sector. 30% expect things to improve there. 34% expect an improvement in the education sector, but 18% don't expect much in terms of the government, and 18% don't expect much in the way of the police. So these are the kinds of numbers, and it talks to you in terms of how consumers really feel about these different sectors, right? And to the extreme right, we have indicated what are the changes over the last period, all right? So if you notice, and we just want to isolate the police, that confidence changes 6 percentage points, and therefore the previous quarter, it would have been lower than that 18%. So what are the things that consumers rely on more in the future? And we can see that they're talking about more apps on mobile phones, more mobile devices like tablets and smartphones, more online banking, 60%, online shopping, etc. So we can see the majority of consumers are going to be buying into these kinds of programs and benefits. And we can see exactly the kind of relative importance of each of them and the change over the preceding period. Most of them are down. Again, that's largely because they were at a high level in the second quarter. Apps on mobile devices, for example, was 75% in the third quarter, and it's down from 79% in the previous quarter. But it's still a pretty high number. So it talks to you in terms of where the consumers' minds are at in terms of their relationship and connection with these devices. So new questions, and I think the dynamism of this particular study is that every time we do a quarter, we see something that we should add or could introduce a new question to help better understand where people's minds are at. And therefore, we ask persons, are you in need of a loan? We're talking in terms of the spectrum of the demographics, upper, middle, lower, nationally representative sample. 25% of all persons that we interviewed admitted that they were in need of a loan. So where are you going to go for that loan? 60%, the majority, say that they would go to a financial institution for a loan, all right? But 26% said they would consider from some personal savings, they would take it out of their personal savings and put it back at some point in time. And 24% said we would borrow from a family member or some friends. But the largest single approach would be to an established financial institution. So it talks to you in terms of, and does feed into financial institutions taking a note of this particular response and obviously gearing up to meet that kind of demand. 25% of the persons we interviewed said they are in need of a personal loan. So, having said that, what do you see as the most challenging loan requirement? Totally spontaneous again. 24% said the collateral, what we have to put together in order to encourage a bank to talk favorably with us. Money in their account, they believe that this is an important requirement and a hurdle, how much money they have in their account. An employer letter, 19%, guarantors. So these are the top things that they see as being the most challenging that they have to provide in order to be able to access a loan. There are other things, of course, proof of address and so on. But the top four, the collateral, money in their account, an employment letter, and a guarantor. So what about the difficulty in accessing personal loans? 17% of the sample that we interviewed currently have personal loans with a financial institution. Was it easy to access? Well, 33% said, despite all that we talked about, 33% said it was very easy to access these loans, 24% moderately easy, and therefore the majority say that, it's not so bad, we can get the loans. I mean, we have to provide all the things that you require, but surely the process eventually works out and we can get a loan. Amongst those currently without a loan, only 20% have ever tried or considered that they could get a loan. So there is certain reservation about those persons who don't currently have a loan, and largely is because they really haven't considered it, and that's to a large extent because they recognize or they believe that there are challenges that they will have to surmount that might be difficult for them to do so. We come to a pretty interesting and very important chart, and you can see we have started plotting this from 2011 because when we were about 10 years into the conduct of this particular study, there were certain indications that we couldn't quite rationally explain. And again, through the wisdom of the chamber and the conference board, I said, I wonder if we should look at remittances. And from 2011, we started to look at remittances. And we can see the pattern all the way up to 2021, where we had an average of about 35–36% of all households, right across the socioeconomic spectrum, clearly higher in the down market area, but right across, 36% of households saying that they do receive remittances from overseas. Where are we now is that from COVID and post-COVID, our numbers are averaging about 27%. Now, the real import of this is that when we break down how people use remittances, the majority of the persons who receive remittances use it to maintain themselves on a daily basis. It goes towards their daily household income, daily household expenditure, and they find that they have very little to save because they use this money basically to take care of their food and their school fees and that type of thing. So that when you look at the situation across these last 13 years that we've been working on this, the number of persons receiving remittances has fallen significantly over the period. Now we're up to 28%. Our low was in 2022, we're 26% of households, a full 10 percentage points less than the peak Prior to that, we were receiving remittances from overseas. So that has made a significant impact on persons' ability to meet their daily household expenses. And that is really what we're saying here. So in addition to the fact that they don't have a great degree of optimism about jobs coming on stream, they're also less cushioned by the remittances that are coming in, and therefore it reflects in the challenges that consumers say they currently have meeting their daily household expenses. So when we go about doing all the kinds of polls we do, one of the big concerns that people express to us is that, boy, things happening, but they're not feeling it. That's a common comment that we're hearing from consumers. And we do several national surveys every year, and that's the same kind of message that is coming back at us. So this is a pretty important piece of information. The remittance inflow is not sufficient anymore, it's not penetrating to the extent that more and more households could in fact ease their burden from the local challenges that they face with job scarcity. So, we've gone through the consumer segment quite quickly. I just want to sum it up in a way by saying, what have we found? Overall confidence has fallen quarter to quarter, and that fall off set in from the first quarter of 2024 and has continued very marginally, yes, less than 1 percentage point, but the trend is really what is critical, and when we see that trend developing, obviously the trend is the greatest predictor of the future. So consumers have a pretty solid view of current economic conditions, but they don't see it improving in the short run. Consumers' expectations, therefore, are in a way at a flat line, And right through, we see that consumers aren't enthusiastic about where they are right now, and they're a little bit cautious about expenditure because they don't know that for sure that they will have the benefit or the luxury of additional revenue, additional income over the next couple of months. And they think, consumers, remember, think right in front of their faces. They're not like business persons who think long term. So consumers are thinking day to day, quarter to quarter, and they aren't at this point in time overly optimistic about where they are and the future for them. So we want to move now to the business phase. And we can see again, very much like for the consumer phase, business confidence has fallen less than 1 percentage point, but again, it's a continuation of a decline which set in from the first quarter of 2024. So again, you have the same kind of pattern, a pretty jagged movement all the way up. And the best period, like the consumer, the best period of business confidence has been that 2017-2019 period, just prior to COVID. And we can see the fall off. Where we are right now in terms of business confidence, we're not anywhere back up to where we were prior to COVID. But we can see that we're going on that particular path up to 2023. The situation has leveled off again in 2024. So that's a pattern. We can see we started in 2001, as indicated before. Where we are right now is that we are at a higher level than we were then, but certainly not as high as we were immediate pre-COVID. We're going to go through some of the same kinds of charts. But before we get there, we can see the last 6 years, so to speak, 2019 to 2024, 5 years really, we can see what has been the trend in business confidence. In 2019, we were at our peak of 144, an index of 144. COVID year fell to 120, dire situation. Rose to 125 in 2021, picking up back in 2022 to 137, up in 2023 to 140, and we figured, well, you know, we're going to be on that trajectory, so the trend is in the right direction. But so far, for the 3 quarters of 2024, the business confidence has fallen by 3 percentage points, 4 percentage points over the period. All right? So we delve into some of the factors that account for that. We asked businesses, and we interviewed approximately 125 businesses Our target is 100. We oversampled by 10% in each case. We ended up with 125 businesses of different types, range of industry types, small, large, and medium. And here is what the business sector told us. So, what about your current profit situation? 17.9% in the second quarter of 2024 said that their profits were better than expected. And that rose noticeably and positively and warmingly to 23% in the third quarter of 2024. And it is substantially more than it was in the third quarter of 2023. So despite what the other rest of the data will indicate, companies are saying, well, you know, our profits are better than expected. Of course, it depends on what is the bottom line. And bottom line, not the right word to use. What is the level from which they're evaluating that profit movement, all right? 67% in the second quarter of 2024 said profits were as expected, you know, nothing dramatic, but that fell to 59%. What you really want to do is to counterbalance that 23% in 2024 third quarter. Say, well, yeah, against that background, you know, there was a more positive outlook in terms of our profits, better than expected. 17.8% said profits were worse than expected in the third quarter of 2024. But that is against the background of the second quarter of 2024. So it's a bit of a mixed bag as far as profit responses are concerned. What about investment and expansion of their business operations? 53% of the businesses that we interviewed said it was a good time to invest. So that's the majority. We want to let you know that this is coming down from highs of 65% prior to COVID, where 2/3 of the businesses that we interviewed said it's a good time to invest. We're pretty buoyant and pretty bullish about our investment climate, but we have not achieved that level since 2021, 2022. There's a fair degree of concern and reservation about now, but the majority still say that it's a good time to invest, 53%, and that's up from the second quarter of 2024, but noticeably down from the equivalent period of third quarter of 2023. But in each of those situations, we see that the majority of businesses believe that it's a good time to invest. And I think that's the big takeaway we want from there. But I counterbalance that by saying, even though the majority are saying so, this is at least 10 and 12 percentage points down from what it was prior to 2021. Then close to 70% of the businesses felt that that's a good time to invest in Jamaica. That is down to 53% in the third quarter of 2024. So, what about the firm's finances? Do you expect your firm's finances to improve? Sure. The majority of the firms do so because clearly businesses are in there for the long run. And when they look down the road, regardless of what is happening now, they expect their finances to improve. So 72% of the businesses that we interviewed said yes, and that's up, you know, like 11, 12 percentage points on the second quarter of 2024. But note, it is substantially down from the period in the third quarter of 2023. But the bottom line is that firms are optimistic. They are optimistic that their situation, their financial results will look pretty decent going forward. Again, firms are in there for the long run, so we're not quite sure what is the time period that they're talking about here, but certainly they expect their finances to improve. What about expectations in profitability? Sure, again, companies are saying we expect our profit to grow up and we expect better profits over the next couple of years. That again is the same pattern as their financial situation, because that is down from 80% to 68% in the third quarter of 2024. So you can see that kind of conservative outlook on the part of businesses. Good, but not as good as it was before. So we say that's conservatism. So what about the changes in the economy? How do you see the economy going forward? Well, 39% in the second quarter of 2024 said that we expect business on the economy to be better. That fell to 36% in the third quarter of 2024, and it is down from the 41% in the third quarter of 2023. But it is almost the largest single response in each case. The majority, not the majority, but the largest single response was the 37% who said we expect it to remain the same. Again, an indication of the kind of level of reservation and conservatism that is being expressed since the second quarter of 2024. Businesses are saying, yeah, we're in there for the long run. We're going through some challenges. We're still getting reports about supply chain problems. And whilst we look forward because we're in there for the long haul, we are a little bit conservative going forward. And I think this is what is being said consistently throughout, and which reflects in that 0.6% fall off in business confidence. All right? So we asked the same question of the business sector as we did of the consumer. So do you think the economy will be better in the next 12 months? In the second quarter, 39% of the businesses that we interviewed said yes, we expect that business conditions, the economy will get better. That fell in the third quarter to 36%. Pretty consistent data. Pretty consistent data. Each leg, in a way, supports the previous leg. Consumers, businesses are pretty conservative at this point in time. But we asked those 36% who said that we believe business conditions are going to get better in the next 12 months. Well, what are you basing these on? What are the drivers of that kind of sentiment? One, the economy is recovering, okay. Two, they're optimistic. So they're, in a way, just like the consumers. Consumers were optimistic. They're optimistic without placing it on anything particularly solid, even though I'm sure they have their own considerations. Some sectors will improve the economy. Government policies, and here is a singled out again, totally spontaneous, unprompted responses. And fifthly, top five, the resilience of Jamaicans. They're saying we're going through tough times, but guess what? We're a resilient people. We're going to bounce back. We're going to, drive towards the future. And we are in there for the long run, and therefore we're going to see it through. This is basically what businesses are saying. But we noticed that in the third quarter of 2024, there's been an increase in the number of businesses that think the situation is going to get worse. That moves from 19 percentage points in the second quarter of 2024 to 27% in the third quarter of 2024. And that's a substantial jump in the number of businesses who believe the situation is going to get worse. So why are you saying so? Top of the line, the economy will not improve that quickly. So people are saying we're still digging out of the challenges of COVID, the supply chain irregularities and the uncertainty and the fluctuation of the dollar and so on. So we don't expect the economy to improve that quickly. Then we have increase in crime, spontaneous comment. We have high prices for goods and services, so businesses are feeling it, they're passing it on to the consumers. We have unstable foreign exchange, totally unprompted response. And fifthly, we have low disposable income. So they're saying they're also echoing the comments from the consumers that we don't have sufficient disposable income. And the businesses are saying that this is actually impacting our ability to actually be more positive. So these are the top five reasons why that 27% that said they expect the economy to get worse, that's the drive. Those are the drivers of their sentiment. So we looked again, this is one of the more recent questions that we added. And what is seen is that what are the sectors that indicate that they plan to increase their capital investment? And we're looking at this from 21 until now. And we can see there's been substantial change over the period. It all depends on what's happening at that point in time. But where are we? And we're seeing that the largest single sector here is amongst the other services, the personal care, the barber shops, the smaller industries. 78% of them say we intend to increase our capital investment to grow our businesses. But when you look across the others, most of them say the majority of them will be doing that. And we can take a look at 56% amongst the tourism and hospitality sector, 56% amongst the farming and agricultural sector. So these are the areas, these are the business sectors that say they intend to increase their capital expenditure over the next whatever period that they are visualizing, but in the near future. So that's our message for the investment houses, all right? Pretty solid message for them. So there is obviously sort of willingness to invest and to seek more capital for their businesses. This is the message coming out of this, right? So, big question. What are the factors that are impacting your decision to undertake business expansion? We say, are there inhibitors? Are there factors and hurdles that you have to overcome? 24%, and they gave us a pretty long list. And we like to mention that it's all unprompted because we're talking about people expressing themselves, the top-of-mind responses that they're giving to us. 24% said high input costs. 18% said the cost of foreign exchange. 16% said the lack of funding and access to finance. Shortage of qualified skilled labor. Crime, 11%. And a stagnant economy as the top reasons. We have about 8 more, diminishing in terms of relative importance, but a significant number talk in terms of the high input costs that they're currently encountering in order to drive their business and to do better. Cost of foreign exchange and the lack of funding. So money is in all of this, right? So it's again a message for the investment houses and the financial institutions. So we then said to the business persons that we're interviewing, what is the most critical issue, as far as you are concerned, that needs to be addressed urgently? Not the same degree of emphasis as the consumers, but 52%, the majority again, single out crime and violence. All right, so well, but they talk about a reduction in crime and violence, but it's all relative, depending on where you're coming from. If you have a 20% drop from a situation which is a pretty high one, then you have a good drop, but it is certainly not what you want it to be. And that's what they're saying here. That 52% of the businesses say that crime and violence is the most critical issue facing the country at this point in time. And everything else pales in comparison. Lack of qualified workforce, 5%, unemployment, 4%, education, etc. But the largest single factor is that 52%. They're not as drastic as the consumers, because when you ask them about the future, 48%, less than in the consumer situation, 48% of them expect it to get worse, which is still, again, a pretty worrying statistic. 48% say they expect it to get worse, against a background of 52% of them saying this is the biggest issue that we need to address right now. Okay, so what should be done to address crime and violence? And they give us, again, a fair degree of response. It's somewhat similar to what the consumers say, but better policing. People are saying we need more policing, better policing, not necessarily larger, but better policing. 33%, a third of the businesses that we interviewed. And that is up by 18 percentage points. So in the second quarter, only 15% cited this, but in the third quarter, 33% cited it. More jobs for young people, similar to what the consumers say. Clamp down on corruption, again, something that the consumers said. More stringent. So the responses, they're all human beings, of course. Some are some are consumers, some are in business. So we're getting these same kinds of responses. Programs for the unemployed, more social intervention, better paying jobs for the youths. And if we look back at what the consumers said, a lot of this is echoed by the business sector. So we can take a look at that and say, well, maybe we should look at those possible solutions and see how we can work together with the the authorities responsible for crime and violence to reduce the level that we are currently experiencing. And it's not to say that crime and violence is not down. What it's saying is that there's still a worrying percentage that is being reported here. Okay. We asked the same question about the confidence that people have for improvement in the respective sectors. And I think we just need to kind of take this as an advisement that essentially there's not a lot of confidence that the sectors that we're looking at here will improve dramatically over the next X number of months or years. People are pretty reserved in terms of their view about the level of improvement that will take place in these sectors, but one hopes, of course, that that will change over time with improvements and the communication and the realities that they experience. So, technology areas of interest for improved businesses. What we find is that clearly a lot of the companies that we interviewed are already heavily invested in technology, and therefore those numbers are relatively small against that background. But what are those areas? Social media advertising, virtual security systems, electronic payment solutions for customers, and new and improved customized software being the top things that people are going to be interested in doing in terms of technology to drive their businesses. Again, just to repeat, social media advertising, recognizing now that social media is a huge phenomenon, good and bad, but a huge phenomenon, all right? When we do our all-media surveys, which we've been doing from so many years and decades, we're finding that there has been a growing shift away from the more established formal media and more into social media. And obviously is the reason why some of the more formal media are now experiencing significant challenges. There's a huge thrust towards social media. So here's where the technology areas that businesses say they're going to be looking at. So, do you need capital? 58% of the businesses that we interviewed said we're in need of capital financing. That's an important piece of information because it talks to you in terms of, well, the business sector and financial houses should be looking at surely. Now, how do you see yourself financing? You know, we're talking about cash flow, a loan from a financial institutions, personal savings, private investors, public offerings, etc. So these are the options that they see in front of them right now. But 58% of the businesses we interviewed say, yeah, we are in fact in need of capital financing, and here are the sources that we would want to be looking at. All right, so again, a takeaway, a very important takeaway for the financial institutions. Right, so we asked the same question of the businesses. What is the most challenging loan requirement as far as you're concerned? Not different from the consumers. Collateral, presenting a positive cash flow outlook, profit on the PLL, strong asset base, and so on. So they talk in terms of the same kinds of things. But 29% interestingly say they're not sure, and maybe those aren't the ones that have accessed financing or sought to. But collateral, very much like the consumers, they say that this is a huge hurdle for them and the most significant factor to overcome in their quest for loans from financial institutions. So, is it difficult? Amongst businesses currently without a loan, a quarter have ever tried or considered acquiring a loan. So they don't look like they are risk averse, that they're risk inclined. So they aren't prepared to go and find money to invest in their businesses. All right? But those that have accessed, feel that it's not really difficulty. 57% say they've been able to access funding without a lot of challenges. All right? So again, that I believe fosters a kind of nice platform for persons to get together, one in the business sector and the financial institutions. And are you able to keep up with your loan payments? Yeah, I don't suppose we'd get much of a negative in this situation, so it was kind of a strange question to ask if you wish. But 71% said, no, we don't have any problems keeping up with our loan payment schedule. which is good. I hope that is reflected in the books of the financial institutions. And 16% said most times, so I guess there's some challenge there. But the largest single takeaway from here is that the businesses apparently are being able to finance, to actually take care of the loans that they have been able to access. And I think that's my last chart. So if I could just sum up the business sector very quickly, and it is that business sector confidence is flat, very much echoing the pattern over the last 3 quarters of 2024. Current business conditions are stable. It's good. It's not falling. It's marginally down, but pretty much consistent across. The current return on investment is slightly up, but not back to where it was prior to COVID, and same pattern for the general consumer. And in both situations, we find that whilst we are digging out of the COVID challenges, neither the business confidence nor the consumer confidence is back up to where it was immediately prior to COVID, which was the peak of the 20 years then that we were monitoring the indices. So we, on a pattern, it has plateaued over 2024, and a lot is left to be seen as to whether or not the fourth quarter of 2024, which generally is consistent with Christmas spending and Christmas expectations, whether that will change this pattern. But at the moment, we're pretty flat in terms of how consumers and businesses feel about their respective environments. So I want to thank you for listening. And,
thank you.
We await and hope we can answer some of the questions that will be asked of us on the panel. Thank you very much for listening.
Thank you very much, Don. Really, as usual, a lot to unpack there, and can be interpreted in several ways. So, I'll ask the panelists shortly what their opinions are of what your results show. You can join us here, please, Don. But I think we have some vox pops, some short videos, couple minutes of persons, interviews that were made with persons in the streets regarding their own opinion of what is happening in their own personal circumstances and in their businesses. So I will ask the technical persons to just run those short videos now before we ask the panel to comment.
No, I don't have any loans with the bank currently.
Volume.
Well, the thing is, I don't necessarily believe in taking loans, so I'm not very sure on what the rates might be.
It says, has recently increased interest rates impacted your personal situation? I think that should be recently decreased interest rates. All right, while we get back to that shortly, panelists, I would ask you quite simply, based on what Don has presented in terms of the attitude and the perceptions of business and consumers, is this in congruence with what you're seeing in your own businesses? Mr. Thwaites, I'll ask you to take the first shot at that. How are your businesses feeling? Is this in line with what you're hearing? And how are they responding to the consumer's needs?
In some ways it lines up, and in others it doesn't. I think overall there is a general optimism. We do see a lot of our members investing in growth, in acquisition, in automation. I think there's a divide between our larger companies and our medium-sized and smaller companies, where the larger companies rely less on access to capital. I was a bit surprised by the access to capital slides, because the discussions that we have, oftentimes that is cited as the limiting factor to grow their business or scale their business, is that access. I'm a bit surprised by what was found there. I do feel like all the consecutive quarters of high interest rates, kind of there was a fatigue factor that played on the business confidence. And I think we were getting to a point that had we not seen some decreases that we might have seen more fatigue there. And then I think as we go forward, it's okay, when is this going to translate into lower costs for our businesses? So those are the areas which I think line up, and some that I'm kind of surprised that there wasn't more of a fatigue about those things.
Based on what you're seeing. P.B. Scott, welcome. Thanks for being here. Based on what we just saw a while ago, your companies are involved in several sectors of the economy, from fast-moving consumer goods to others. Are there your consumers sharing this sentiment, and are your business boards looking at these things and having the same thoughts as have been reflected here?
Yeah, so thank you for having me. When I was looking at your results, they somewhat reflect what we see in the domestic market here in terms of our sales. I mean, it's been fairly sluggish this year so far. I think the inflation of last year and the previous year has definitely cut in or made goods more expensive. But when you look at the interest rates and the effect of rising interest rates, I'm the chairman of the Development Bank, and we just had our retreat over the weekend, and we have an incredible product called the Credit Enhancement Fund, which guarantees for banks, small firms, loans. And an incredible statistic, which shocked me. I think 3 years ago, only 20% of all loans of small firms were at above 15% interest. 2 years ago, it was 50%, and this year it was 76% on those portfolios. Now that's a huge increase in cost of capital for that segment. And that is the segment, I guess, that when you're interviewing 600 businesses, whatever you're going to be interacting with. So monetary policy has definitely had impact and had a bite, and that's somewhat what it's designed to do. We kind of have a strange situation in Jamaica where we sort of import inflation, and it's more cost push rather than demand driven. And monetary policy tends to be the sort of cure for demand driven inflation opposed to cost push. Because we have the cost push, and we're now creating further cost push by increasing the cost there. So I somewhat share the views of what your polls say. I don't know, we have an independent central bank, something that we should be very proud of and should defend, because I think that's building institutions and creating independence is incredibly important for Jamaica's future. But I'm not of a view that we're going to see interest rates just drop off a cliff and slide down. I think it takes a little time for readjustments to occur. So the views that you had, do you think things are likely to get better if they correlate to the cost of capital, is probably a longer term view. I would say that as Development Bank of Jamaica is open for business. If your members need capital, particularly for manufacturing, etc., the mandate of that bank is to support productivity in the development of the country, and they do have a lot of capital and a mandate to do direct loans now into the sector. So maybe they haven't done a great job in articulating that, but there is capital available there. But there is massive, even for large companies, I think it's very different. The liquidity in the market, in the capital markets, is not what it was when your numbers were much, much higher. and that's real. That's tricky, and I think you see that in the news playing over with some financial institutions and entities sort of in the marketplace. They have to pay very high premiums now to attract money because it's somewhat scarce. So it's not surprising what's on there.
Thank you very much, PB. Jerry, your time. As the relatively newly minted Vice President of Investment Banking at GK Capital, congratulations, by the way, and welcome home. Where's the demand for your product and service, and what are your customers really echoing? This same sentiment, and what can you, through your organization, do to sort of ease the tension, so to speak, as it relates to lack of confidence and lack of solid feelings about what's going to happen going forward?
Well, certainly good morning, and it's a pleasure to be here. We're delighted at GK Capital Management to be sponsoring this important initiative. And it was interesting speaking to Mr. Anderson recently. He was telling us how he was listening to a president speak about how many hotels they plan to build in this particular country. And Mr. Anderson asked him, well, what data are you using to make that decision? And the president actually stopped and said, well, an awkward pause. But certainly, information is key, and this kind of information impacts, all aspects of the group that I'm so proud to be a part of, the Grace Kennedy Group. We've been in Jamaica for over 100 years, so clearly we're very optimistic on Jamaica and indeed the rest of the Caribbean. So the information was really fascinating because on the food services side, a lot of the consumer aspects and information would impact that side of the business. On the financial group side, which represents the banking, insurance, and then GK Capital Management, which is the investment banking side, certainly the business information of the relative confidence, the plans for expansion, 58% looking to raise capital. Certainly, that is what we're hearing, and that is the solutions that we want to provide. I noted that collateral was the biggest issue that many businesses saw. And on the side of the business that GK Capital Management is, we really don't look on just collateral. We look at the cash flow, we look at the future of the business, and our ability to provide capital to support these businesses is exactly what we do. So, the message here, I think, is encouraging. The optimism that is within the business sector is something that we want to support. And certainly, as Mr. Scott said as well, PB, the government has a role to play. There are resources, and certainly the private sector, through the investment banks, through the commercial banking sector, the resources are there to support businesses as they go forward.
Right. As it relates to access to capital, this is a strong theme, but there still is a majority that are not using all of the methods available, all of the facilities. PB just mentioned the underutility of the CEF. And I noted also that only 4% of the businesses looking to raise capital would be looking to do so through the capital markets, through an IPO, for example. While Don's survey spoke specifically about access to loans and relative ease, generally speaking, of access to loans, small and medium businesses would probably better benefit from capital injections in the form of equity. If only 4% are interested in that method, what does that say? What kind of work do you have to do to both PB and Jerry from your end, and also Mr. Thwaites from the JMEA, to convince? We have a long-standing program going with JMEA in terms of creating access to long-term capital. But what can we do to change that 4% to a larger figure, Jerry, in your estimation? I mean, high input costs are there, and that certainly affects when you're borrowing, when you're doing debt. And those high input costs eventually are passed on to the consumer, and that's why you see consumers talking about high prices. Certainly, equity investments, in my estimation, can buffer those costs and result in more patient capital. So to move that 4% needle, Jerry, how do you see us doing that?
I think there's work to be done to educate the players in the economy, especially on the small and medium enterprise segment, that the capital markets, whether it's equity or bonds, or let's call it non-traditional or non-banking type financing, is available. I think people just don't realize that it's out there. I think maybe there's a perception that you have to wait, to get to a certain point before you consider it. However, I think the work needs to be done by the investment banking community to really educate and start working with companies to say, okay, these are the options that are out there in terms of raising capital, for your businesses. So I think there's just a perception issue, and I think the investment banking sector really needs to get out there more and to let the players in the economy know, outside of Kingston, around Jamaica, all parts of the country, all sectors, that the capital markets is open, it's ready to provide support. And the point that Mr. Scott pointed out, that at DBJ, that the SME sector is really, the interest rates that they're paying, are really high. That's a big concern, and there are solutions that can be provided. So I think it's, it's getting out there, talking to players in the economy and saying, hey, there are choices, and start working with them to get to the point that enables them to ultimately list on the stock exchange, for example.
Right. Sydney, I know that the JMEA has done some work in this regard in forming alliances to generate better confidence for your businesses by giving them access to capacity building, to other kinds of support that will lead them to properly capitalize their business, increase the confidence in the business, and increase the value and the quality of their products. Have you any success stories to report on those initiatives with private sector companies, with public, with DBJ, or any other that you can report? Any success stories? Because we've been on this for quite some time now. The manufacturers and exporters have been crying out quite loudly for support, capital support. Have you any success stories in that regard to report?
We do, and I think Sherry's right in that there's a perception issue around timing of accessing the public markets. That is always something you have to contend with, and I think where the most effective tool we've seen is to have your examples out there. If you talk to a Fosrich and you put examples of different companies out there that have gone from a certain level and what they've achieved after the public offering and how they've accessed those markets. I think as you ask about the tools out there, I think the examples are the best ones you have. But as Mr. Scott said, the DBJ has been very active with the JMEA and is very top of mind now with a lot of our manufacturers. So as we hear the discussions happening, I think probably DBJ is one of the most top of mind ways of accessing that capital right now. And we do have a number of manufacturers who are either through that process or starting that process.
All right, thanks. What, PB, why, looking at the numbers that just came out, that says that the majority of the businesses, Don, you can remind me what the statistic was, felt that in the next 12 months the economy would be actually worse. Given all that we have available to stem that tide, what would be in the minds of businesses that would lead to that sort of sentiment, that the businesses economy be worse in the next 12 months, given the fact that we are in election mode, I would think, since February, because we had a local election, and we're going into a general maybe, God knows who knows when. But what, generally speaking, I'll ask Don the second part of the question in terms of the post or pre-election excitement. But why, PB, at this time, would businesses say that in the next 12 months the economy would probably be worse?
It's a very tricky question. But I just wanted to comment on what you were commenting on and make another plug for the Development Bank of Jamaica. Sure. Because one of the important things the Development Bank of Jamaica has done over the last 5 years has created a private equity ecosystem. And they've raised a substantial amount of money, which they have invested in private equity funds to invest in small businesses and provide capital. Those funds are managed by fund managers. They're real, and they have a lot of money in them and are designed to make private equity investments. I think it is somewhat naive in Jamaica to believe that you can. It's complicated. It requires a level of sophistication to go and get a listing and raise money on the public markets. You have to have, the business has to reach some level of maturity. And unfortunately, capital formation in Jamaica has really not been that consistent, and we haven't had a stable environment for, this is really our first period of stability, the last sort of 8 years, I guess, since the IMF agreement came into place, that we've had since the early 70s, where we haven't had a rate of inflation or a moving foreign exchange rate and high interest rates. So capital formation does rely on the confidence and ability and stability, and as such, we're now forming the ability to do that, and eventually these new formed legal entities will develop and grow, and they can access seed capital. And I would suggest they talk to the Development Bank, because the Development Bank can put them in touch with these funds. These funds don't make money unless they invest. So, they have the money's been dispersed, it's there, and they're there to make investments in Jamaica in equity. So I think that is very important, and the more conversations that can be made and discussed around that 4% will increase, because people have to feel comfortable. I mean, no one likes to be diluted. No one likes to have partners. It's very, very difficult to bring other people into your own world where you're used to walking into and do whatever, and to have that external discipline. But the more conversations we have about it, as uncomfortable as they may be, that number hopefully will increase. And I took note of that number, and I think DBJ has a role in going out there and articulating and talking about it, because that's something that we should be paying attention to. And I'm going to ask them to get a copy of this, because we should measure ourselves on that 4% and see as that increases, to see as a metric of our own performance. Your question with regard to why would people believe that the economy is not going to be improving, et cetera, in the next 12 months, I think I spoke to earlier with regard to, I think clearly, interest rates are fairly high. Liquidity is relatively tight. We have a very interesting dilemma in Jamaica that people have not really spoken much about, but I think it's a byproduct of the success of the fiscal discipline and writing of our fiscal deficits and management, has been that when you think about it, the debt to GDP has dropped from 150 to about 70, and that's incredible. But what that really means, it means the money hasn't disappeared, right? It means that effectively that debt stock that was absorbed in government Jamaica securities, or debt in some shape or form, that represented 150% of debt to GDP, has gone into other types of physical or securities investment assets, right? And it would not be normal under any circumstances, and it's not a reflection on Jamaica, it's not a reflection on our capital markets, but it would, because I think in any country where you have a change in portfolio so dramatic and so quickly, you're going to have a situation where people make bad investments. That's going to follow as night follows day. Because you can't take a flow of money that has been built up over several decades, and essentially an industry that has entirely based its total competence on just placing money on government sovereign bonds, basically at the highest yield, and then say, okay, you need to go and invest in other things, because they haven't been trained to do that. They don't know what they're looking at. They look at spreadsheets and PowerPoints, presentations, they go, but invest in private equity. Oh, that's a great idea. Let's go invest in this. And they do it. They don't go and kick the tires and check and go, what's that red button? Press that and check the number of widgets that come out of a machine and count the number of trucks that leave the building and verify it. They don't do that, right? Because the velocity of requirement to place the money to work and the culture of just sitting in an investment meeting once a month and sitting in an air-conditioned environment and looking at it and making a decision after an hour is not going to be the same as what is required to achieve alpha, right? To achieve alpha, you need to get on the road, drive in a car, jump in an airplane, go check it, sit in a warehouse, go count, that's not what that's going to be. So what's going to happen is, over that period of time, you're going to see, and in financial institutions go, oh my goodness, we're invested in something in a foreign country that doesn't generate any cash flow, and by the way, it's never been turned on, and as a result, oh, and you know what, someone else is investing in that, someone else invested in someone else, that was a bad investment. And that tends to create a confidence issue, rightly so, because they should recalibrate, relearn, make sure they don't do it again, right? But the byproduct of that is lack of activity until you get the level of confidence and capacity and capability to do it. And that is also kind of happening in a way. And what we have to make sure is that we have a containment of that and it's not so overpowering. I mean, when you look at somewhere like Japan in the 1980s, Japan was the global superstar. Everyone was studying Toyota and how they were amazing at producing products and stuff, and economic growth was great, but interest rates were zero, and what happened was people didn't value money, and they were lending to a lot of different people, a lot of connected parties, and you had a massive debt overhang. But it was a private debt overhang, much like what we had. We had a public debt overhang in the 90s that caused a situation where it just weighed down economic growth. Japan had a private debt overhang that weighed economic growth. They could have made a choice. We would have had a private debt overhang if the government hadn't interjected, just took it from the private sector and put it on the government sector. Yes. But in the end, it's one economy. Whether it's the government or the private sector, it's still Jamaica, right? It's just moved between two components, right? What we need to make sure is, and that's why I was talking about it earlier when we talk about we have to respect institutions, the roles of the regulators, the roles of the Bank of Jamaica, having an independent Bank of Jamaica is so important. But we can't allow the fact that we may have a level of uncomfortable situations. There will be failures. I'm not saying institutions will fail. I mean, investments will fail, right? You will have some bad debts, some bad private equity transactions, some bad things. But that is the nature of capitalism. And unless we embrace capitalism and not be half pregnant, and go, oh my goodness, there's a loss there. We can't allow that to continue. That's a problem. No, you need a loss. People need to lose in order for some people to be able to win. And it's not binary, just because one person wins, not because they lost. But the reality is, if you're having a race and Usain Bolt was the only person on the track, no matter what speed he got at the end of it or time, it would be unimpressive that he won because he was running against himself. So it's good to have a whole track. You need someone to have lower returns in order to make the people with bigger returns. But what needs to happen is the market needs to be return-orientated, performance-orientated, not relationship-orientated. It shouldn't be because I know him or that, or I was at school with him, or let me make a telephone call. And that's natural, because in the first time when money becomes available, it wasn't there. It's going to be relationship-orientated. Then they're going to lose, and then it's going to be performance-orientated. We will start to develop and grow on a sustainable way when everything is performance-orientated. where substance takes priority. And that's what's going to drive it. And, you know, we're just in a little blip in that, that's all. You know?
So the business's perspective is probably short-lived then. Ladies and gentlemen, that's your news headline for 6 o'clock. Jerry, yes, we've seen interest rates started to come down. But let's say I'm a small business with a variable rate loan at a whatever kind of institution. When am I going to start to see and feel the benefits of what is being heralded now as a watershed moment in the business sector, the capital markets, and the money markets? Man on the street, when is he going to feel this benefit?
Well, it's going to take time. I mean, that's probably the simple answer. The reality, as the president of JMEA said, you know, interest rates have been high for a very long time. And what happens is that when the central bank drops rates, the lending rate doesn't immediately drop. What may happen sometimes is that the deposit rates will drop even further, faster and further, as opposed to the lending rates. I think you're referring to the borrowing rates. Yes. And so the reality is that that's going to be, it's a little sticky. I mean, each institution will make their own determination, but eventually it will come down. But I think managing expectations is important, that it's not just binary, that the central bank drops rates and then immediately, you know, lending rates drops. So you're going to see probably deposit rates drop a little faster than the borrowing rates, but eventually rates should come down.
Right. You see, that is where the investor and the manufacturer, my manufacturer friends cry a lot that, you know, they may have some money in a deposit to secure some facility, and the rate on that drops almost immediately. Whereas the lending rate for which that asset is securing, it takes a longer, and there's an impatience because of a misunderstanding, I would think, on how that actually works. So that's a good clarification. But Don, I don't want to leave you out of this discussion, because what I'm noticing is that I know you're enjoying the discussion, but you asked the question. We traveled together recently, and one of the questions that came up is in terms of investment and business decisions being made is how much of your decisions are data-driven? PB touched on it a while ago. You talk about relationship-driven and all that kind of thing. What are you finding? Is there more reliance or more demand for your kind of service where before you make an empirical, deep, long-term, significant financial decision, that you get the data, analyze the data, not just 1 month of data either, before you make the decision? Tell us about the importance of this kind of data and other types of data in making an assessment before you make a business decision.
Very good question. I mean, I've been in the research business long enough to say that there was a point in time here where some of the largest companies would make decisions from the seat of the pants, where directors would meet and say, I like this idea, you know, and let's move forward, to the point where today, the large majority of companies that we relate to or with, from small to medium to large, recognize the value of being data-driven and to making decisions on the basis of accumulated data over time, over a point in time. So this is becoming, as far as we're concerned, a very important aspect of business growth. Now, without mentioning the country, Jerry and I were together again recently, same place you were. And we heard one of the leaders of the country talking about the grandiose plans that were being made, you know, the roads that were going to be built, the hotels that were going to be established, the hospitals, and it struck me as somebody, you know, my organization has been involved, for example, in the origin and destination studies that have led to a lot of the highway construction here, you know, which has been informed as to how long the highway should be, how many lanes it should be, how far it should go, etc. So I heard this leader talking extensively about the plans, and I was intrigued. I said, excuse me, but how much of this is data-driven? And again, I make the point, there was a stutter, and it says, not much. I think a lot depends on where you are and the stage of the development of your country. But I think certainly from our perspective, there is a significant degree of reliance now upon data to inform good management decision making. And I think this is an absolutely fantastic place to be. But again, in some other countries where they're pretty much developing on a sort of ad hoc basis, where plans are being made, buildings are being constructed, hospitals are being laid down, and then they're saying, hold on a minute now, is this the right place? Unfortunately. But hopefully we'll get over that particular point in time. But I think to answer your question directly, a lot of decisions today are being made in the right way, which is being data-driven. And I'm happy to be in the middle of it.
So a lot less decisions, you believe, are being made without data?
Well, there was a point in time where I tell you the very, very few large companies made decisions on the basis of data. Mm-hmm. And I think they have gone beyond that stage now to hardly any company makes a decision without good data.
Okay. Happy to hear that. That's a good sign. And JME, I hope, is using some of that data or calling on that data before making the decisions. Mr. Thwaites, President of JME, we see what the business's sentiment is. We see what the consumer sentiments are. What would you consider to be your top 2 items in terms of a wish list to improve the lives, basically, of your members?
Well, it's not a secret. When we get together with members, the things that keep coming up are the cost of energy and the cost of capital. Those are the top 2 things that if you asked our members, and remember, we've got 500 and odd members, and 70% of them are small and micro. So we run the gamut of the very large businesses, medium size, but a lot of our members are at the smaller end of the spectrum. But those 2 things are the things that they dominate conversations, and it's access to capital, not just the cost, but the tightness of the capital markets. And a lot of it has to do with the readiness of the organization to be a borrower. You know, we have a lot of companies that are struggling just to get there as opposed to getting to the sophistication to entertain an IPO. I mean, imagine what that movement in the sophistication of a business is. But I think one of the hurdles is that to manage the energy cost of a manufacturer, it takes investment. You can't do it on JPS, so you have to make an added investment. That's a lot of companies, and that takes access to capital to make that investment to drop that cost, and then you've got the cost of capital. So it's a dilemma that we see a lot of our businesses struggling with, and that's why it's really good. I was at a conference on Sunday, and part of the discussion is the new initiatives and new loans around energy and alternative energy and lending into that at low interest rates and getting companies to a point where they can drop that cost of input. So those are the 2 things that come up in every discussion.
And we have 2 lenders in the room as well. So, I mean, yeah. I know the development bank does have some facilities around green financing.
One of the most important things that the Development Bank does, which is, they do it very well, is the voucher program. The Development Bank will give grants to businesses to fund professional services, such as accountants and other consultants, to help them put their business plan together in order for them to be credit ready.
Yes.
And you know, that's an incredibly important component in the journey of capital formation, to be able to borrow money, then to go to be ready to, because I mean, the truth is, the likelihood of attracting equity capital without any cash flow or anything like that, or the business somewhat formed, it needs that first debt. Mm-hmm. And look, let's call a spade a spade. Capital has a price. Price correlates to risk. When you look at the prices for some businesses, it correlates pretty much to an equity type return. It's an equity type return because the debt is basically the business in these undercapitalized business, and probably deserves an equity type return. Mm-hmm. But in many cases, and I'm not demeaning the fact that you do need capital. There's no doubt that you have to have the access to capital. It's kind of binary. You want to address the energy issue, then you need to buy the equipment to address it. That requires capital. It's direct. But in terms of the development of a business, if a business fundamentally is not going to work on a, let's say, a 12% interest rate, and it's going to work on an 8% interest rate, it's probably not a very good business, because the difference between the two is 4%. And really, the more important thing is what's the amortization of the principal, and when it's, and how long you can get the money for. Can you get 7-year money, or is it a 1-year money, and you're going to have to hit a refinancing issue in a year? It's not so much the coupon rate. Everyone's obsessed with coupon rates, but that's really fundamentally not what's going to drive the cash flow of your working capital to develop a business. Now, the problem is, the biggest issue, I think, is educating people to understand that cash flows are the most important thing, and the inputs into that. One input is the amortization and the interest rate, but there are many other inputs.
Yes, so problem, high cost of capital, high input cost generally, high cost of energy. Solutions are out there. Jerry, would GK Capital have any interest or are currently participating in any initiatives for your small, medium businesses as it relates to managing those high input costs, whether it is, what type of structures would you have in place to help those people?
Absolutely. That's what we do. We mentioned Usain Bolt. People forget Usain Bolt had a coach, that was behind him working with the business. So in many ways, investment bankers, we're like that coach that's trying to help the business to achieve, success, and however you measure success. So we do have a range of products and services. And again, to give a plug to the DBJ, just yesterday I was talking to working on a very large transaction, and the principal, didn't realize that there were benefits to be had in terms of funding through DBJ, in terms of interest rates, tenors, and so on. So certainly, as a coach would work with Usain Bolt and tailor a solution, we would look within our resources, within our group, to provide solutions. So whether we draw on First Global Bank on the commercial bank side, or we go to the capital markets in a private transaction, or ultimately a public transaction. So we'll look to provide a solution that's tailored for the business, that addresses the issues that you just pointed out. But as you point out, in terms of the cost of capital, there is a cost of capital to a bank or to an investment bank. So on the bank side, it's deposits, right? And then you have that spread. Similarly, in the investment banking world, capital markets, you have investors that provide that capital, and then they need a return. And that cost is driven by, there's some factors that are just outside of your control. So whether it's inflation, whether it's where the government rate is, certainly there's a risk premium as well. So that cost, there's certain things you can do to address that cost of capital. The last thing I would say is that, in the capital markets, there's things you can do to address the immediate impact of interest rates, for example. So, for example, you have zero coupon bonds. So where maybe for the first, year or two, there's literally, you're not paying interest, but, you're going to pay it on the back end eventually. So the point is that you can create structures that make that cost of capital suit the business and provide the support that it needs. I should caveat to say, though, that those type of structures are for more, larger businesses, and it's not for SME type businesses. This is for larger companies, but there are solutions out there, and working with professionals within the investment banking space or otherwise can address some of those concerns.
Yes, I think, in this room, I would say market education is a constant that we need to do, and I would say with PB present and yourself and the organization I represent, I think we can jointly continue a series of market education activities that will help to boost the capacity, at least the business acumen of some of the persons we're trying to help, and remove that fear of formalizing your business, because I think that is a big part of it. Two more questions. One, which is the elephant in the room constantly, every quarter done, crime and violence. Sydney, how much of an issue? It's clear in the survey that this is a problem. How are your members reacting? How are they surviving in this environment? Because as we speak about the high input costs, we speak about the high cost of capital. The third one, which might be the first one in some instances, is the cost of security. What is the sentiment of your, and that certainly evidently has an impact on consumer confidence. What is the sentiment of your members? How are they tolerating? How are they surviving? Many of the companies, I was part of the JME Awards just the other day, and several of your companies, member companies of all sizes, are doing very well, despite the surge in crime and violence. What is happening in that regard? We had a session last year this time, the topic of the business and consumer confidence panel discussion was crime and violence, and the data-driven aspect of it and how it is impact, and it was very significant. But I think you were part of that session in some regard. What is happening now?
Just to put it in context, so we did a survey at JMA of our members.
Oh, Don Anderson did it.
As it pertains to the cost of security. Cost of security over the last 18 months is up over 60%. 60%, and it's a significant component of what companies are spending. That part of it, is causing a lot of our members to look for alternative ways of dealing with it. But if we take a step back, and you mentioned it earlier in your presentation, Don, you said that even though the numbers are down, that we're being shown that our crime is down, I believe the number is 16%. If you talk to the average owner of a business or the average Jamaican on the street and you told them that our crime is down, how many are going to actually believe you? Not very many. Whenever I say it in a group of even business owners, they tell me that's not true, because the feeling is not there, because the cost burden is getting so burdensome for these businesses. Wow. So it's really, and it's a cost we have that our competitors in other places do not have, and that's the important thing. When you go to DOMREP and you visit a factory, that's not on their radar, that's not a part of their consciousness. And here, when you go to a business, last time you go to a wholesale business, you have somebody who sells you something, and then it's handed to someone else who's going to check that. Then you go to a cashier and you check that. Then you come back and get your goods and check that. That's added costs that these businesses are putting in place to manage that perceived risk.
Problem. Same question, PB.
I think it's very difficult with the rising costs and security costs and having that layer of costs that your competitors outside Jamaica may not have. But I really think the bigger cost is not so much the security guard or that expense. I think the bigger cost is the lack of productivity that comes into the workplace from crime as a result of that. And I mean this just every single day. Just think about being late for a shift. Is it your fault you were in a bus because someone did not obey the law and went across and did something? The fact that if you're investing money in a factory, and I get it, sure, we have energy challenges and we have security challenges, but the reality is we also have inefficiencies in exporting, the cost to export and all of those things. Why do we have inefficiencies in export? We have inefficiencies in export because of crime. Because of the criminal situation that is exporting products that we're not supposed to be exporting. It's resulting in extra costs of inspecting containers, et cetera, which makes your exports more expensive. You are investing in, let's say you invest in a factory and it's first-rate equipment. The reality today, just because we're in Jamaica, doesn't mean we can't buy the same equipment that someone in Taiwan has. You know, our dairy operations at Surge, if you go in there, it's actually in Bog Walk, but we still call it Surge, but in Bog Walk, are as modern as the very best you could get in New Zealand, right? However, the reality, we don't have this so much at Surge because it's in the country, but if you take our factory on Spanish Town Road, those factories, once you invest that level of money for the very best equipment, the equipment can produce. It's driving the productivity, more so really than labor, although you need the appropriate labor to run the equipment. It kind of goes together. It needs to be run 24 hours a day. But if you can't get a workforce to work between 12 and 6 in the morning because they don't feel comfortable, they'll agree, you know, but the absenteeism that you have because they don't feel comfortable traveling in the dark, walking from the bus stop because you don't have lights, you have no security, that destroys productivity, And that's fundamentally going to be the story of Jamaica. Because the difference between where we are and where we need to be is addressing the productivity question. And if we don't address the productivity question, which is so correlated to crime, it's also correlated to education, but crime is also correlated to education, you know, that we're not going to grow. You can't have the lowest unemployment rate in the history of the country and have an outlook of a negative GDP. What does that say? It says a lot about productivity. So we clearly have to address it. We have labor legislation in Jamaica that has to be addressed. It's a hot topic. It's very sensitive. People don't want to address it. They're unlikely to address it, probably. I don't know. But I can tell you, we're not going to get much productivity without it being addressed. Crime is something that affects productivity, and that is the biggest cost to our society. You think about the migration rate. Think about Jamaica. And you talk about ComDomRep. Every country in Central America has increased its population from the year 2000 by over 50%. You take Guatemala. Guatemala's population was 10 million in 2000. It's going to be 18 million today. You take Jamaica, our population was 2.7 in 2000. It's going to be 2.7 today. Our death rate is, I believe our death rate is about 9 in 1,000. Our birth rate, which is halved since 1971, is 14 in 1,000. Our migration rate is 7 in 1,000. What does that mean? And by the way, our population is now declining because of this. But not only is it declining, so we have a structural demographic problem, the individuals that are creating the productivity, that are consuming, and who are part of our equation for GDP growth, are being replaced by babies. So even if you have the population at 2.7, the adults are migrating and being replaced by live, breathing, beautiful things, but they can't produce anything, and they're not going to consume anything, and that creates a structural problem for economic development and growth. And it must be addressed.
Very good point. Thank you very much for that, PB. That's a very interesting perspective. I think we have our Vox Pop ready now. I really want to, we put a lot of work into getting the sentiment of the people on the street, so I'd want to, if you could play that now, please.
No, I don't have any loans with the bank currently.
Well, the thing is, I don't necessarily believe in taking loans, so I'm not very sure on what the rates might be or what's available to the public now. I do hear some conversations. Sometimes people might say the rates are getting higher and higher. But I see the BOJ just dropped in the interest rate amount this week or something like that. So I don't know if that has any bearing. I don't know if it's too hard. I don't know if it's too much. I don't know.
Not really. Not really.
Current loan, no, because I don't currently have any loan that's pending to be paid back.
I mean, I may be more likely to borrow in the future.
Well, if I were to borrow, then it might. I might rethink what I'm borrowing for. So if it's not education, mortgage, maybe a car loan, I probably would not. So I'll just be going for the more pressing matters, you know.
Most certainly. Yeah, because I mean the increase up behind my back. And me only recently find out say there has been an increase, and that is quite ignorant if you ask me as a citizen of Jamaica, without my knowledge as a citizen. I mean, you might know, and a taxpaying citizen as that, at that. So it does affect me.
Yes. All right. One, I have 2 kids. Boys to be specific. All right. My rate for me I get right now are $418. Right? I work 9 hours each day for the week. And to cover the fortnight, it wouldn't reach up to 130 hours. As you know, the working hours according to the government is supposed to be 80 hours per week. So my loan when me take now go match up to me paying it back.
Okay.
Because with rent, my 2 sons, and household expense, and otherwise, sometimes I drive, sometimes I walk because I have a car. I can't go manage the rate, the rate with the loan.
Okay.
Saving in this economy, I am at negative, so there's nothing to save.
Well, theoretically, I don't believe there'll be more chance for saving if the rates are higher. So, probably not, no.
No.
All right. No. Less, can't save.
Honestly, I expect it to go back up. I would like if it continues on a trend of going downwards to reduce the inflation that we saw during the COVID years, but I don't really have hope in that happening. I would just keep doing what I'm doing. I try to reduce my expenses as much as I can. I'm not going out at all. I'm not doing anything that's not essential. I'm still barely floating. So I'm not sure that I can do anything to prepare further. Hopefully other persons that have savings from the lowered interest rate will be able to help the economy recover, because I cannot.
Well, based on that whole promotion going on about the reggae rhythm and the baseline, that kind of thing, about keeping the rates down, if we're able to, I'm thinking, if we're able to build the economy to the more production, more exports, then we might have a better chance of bringing down the rate and then probably seeing more savings, more opportunities for expenditure. So we might have a bright future, but it depends on what we do in the next 5 to 10 years, to be honest.
It needs to be balanced. Like, come on, bro. You know, you have upper echelon, obviously you have the middle class. Well, I mean, I travel, so I realize my country is stable in our way, but we can do better because we have educated people and people are capable. So going forward, we definitely need to create a way where the interest rate can be fluctuated, meaning, you know, the poor can survive and even the less fortunate. You feel me?
Focusing on savings and interest rates. All right, I think we've had a very good session. Don, the last question I have is for you. Given that we're in election season, I haven't seen, you spoke specifically to periods immediately post-elections where you see spikes in indices. But has there been any time prior to elections where you see consumer confidence or business confidence changing? Or is it still factual that when you're approaching elections, people keep their hands in their pockets and they don't spend and they don't do anything? They're very conservative. Are the results now showing any election-related consequences? And going forward, are you expecting that in the next 2 quarters that we will start to see this?
I think what we are finding is that there has been a significant increase in the maturity level of voters, strangely enough, because when we look at those 3 peaks prior to now, people bought into the election promises and then were disappointed generally, regardless of who was in office. Disappointed at the lack of commensurate return based on the expectation. I think from the 2010-11 period coming forward, we have seen a greater degree of maturity amongst the electorate. They don't buy into these promises to the extent that they used to. And hence you don't have that kind of peak and fall off that we had. So I think today what we're seeing is a wait and see approach to a large extent. We have been doing a lot of other national polls, etc., and we don't see a significant degree of response. And we have a number of questions in a poll that we're about to release, by the way. And people aren't responding to the election promises to the extent that they used to prior to 2010. We put it down to the maturity because people are looking more at issues nowadays rather than the kind of blind support, you know, for a particular party. And I think we're not seeing the kind of knee-jerk reaction to political statements like we used to. So there's a level of evenness in the flow and the sentiment of voters today. So I don't think you're going to see any rapid change in the perception of the consumer stroke voter over the next 3 months, 6 months, 9 months, or 12 months.
All right, thank you very much. I think we're at the end. Are there any one question we can pick out online, if any? Rachel, anything there? Not this time. Okay, PB clarified everything. All right. All right, on behalf of the Jamaica Chamber of Commerce, I'd like to certainly thank our sponsor, GK Capital. Thanks to the organizing team led by Rachel and Andrea. We also want to thank the Pegasus, of course, for providing us with good accommodation today. Hospitality was at the first-class level. Thank you to my panelists, Jerry White, from Vice President, Investment Banking, GK Capital Management, Mr. Sidney Thwaites, President of the Jamaica Manufacturers and Exporters Association. Of course, P.V. Scott, Chairman, CEO, Musson Group, and Chairman of the Development Bank of Jamaica as well. And of course, Don Anderson, Executive Chairman, Market Research Services Limited, for excellent work, a lot to unpack. We continue to work with you, and thanks to everybody who joined us online. We hope that you will join us again for the 4th quarter release, which will be in the 3rd week in January. Am I right, Andrea? Yes, 2025 is not that far away. Thank you very much, everyone, and have a productive day.